Hi, this is James Shug with Westpac London's end of day report for Thursday the 17th of November. Very much a risk-off day today. European concerns to the fore once again. France and Germany are arguing about the role of the European Central Bank. Should they step up to the plate and act as either a lender of last resort to European governments, which is effectively what they would become if they started hoovering up the bonds of those sovereigns in Europe that basically can't seem to sell them to private investors anymore. The French would like them to. The Germans say no, not on your life. It's be too inflationary. This is an issue we're going to hear a lot more about going forward. Our view at Westpac is that the ECB probably will need to buy more bonds at some point because without them, their yields are going to arrive to such unsustainable levels that Europe will just stop functioning as an economy. So very much watch that space. The other story related to that, of course, is that the Spanish bond auction didn't go off too well. Compared to 4 weeks ago when the Spaniards had a 10-year auction, yields rose 1.53%. So the 3.5 billion they auctioned off went at 6.98% today compared to 5.43% on October the 20th. When you think about it, over the 10-year term of that borrowing, that 3.5 billion euros is going to cost them an extra €500 million in interest payments over the 10 years. That's why we're worried about what's happening with bond yields in Europe at the moment. Markets are charging huge amounts now to lend money to these governments, and at some point the risk is the bigger governments of Spain and Italy will simply not be able to continue to fund themselves. On the data front today, news was pretty good in the US. We had housing starts which weren't as weak as expected. Although when you look at, this is for October, when you look at the 3 months to October though, housing starts are still down, down 15% on the pace they were running in the first quarter of economic recovery back in the middle of 2009. So whereas the economy's been recovering for more than 2 years, housing on this indicator and others is still going backwards, and that's why this is a really atypical recovery in the US, and it's also why it's proving to be very difficult to sustain. It's very difficult for America and other major economies to sustain a recovery without the housing market participating. The Philadelphia Fed factory survey pulled back from 8.7 to 3.6 in November. Market had been expecting a rise. It actually fell quite sharply, although not quite as far as our forecast of a fall down to 2. Shipments and orders were down, but the jobs index was higher in that survey. Initial jobless claims fell 5,000 in the latest week. It's actually the survey week for non-farm payrolls as well, down 5,000 to 388,000. So they've been below the 400,000 level for a couple of weeks now, and indeed the latest week is the lowest figure for claims in 7 months. So an indication that that part of the labour market perhaps is improving slightly, or a little bit less weakness coming through there. But that's about it really. The US data wasn't good enough to offset those European concerns. So as I speak, just coming up to 6 o'clock in London, we've got the Dow down 0.5% at 11,851. The FTSE closed down 1.6% in London. The French market down 1.8%. And the German market down 1.1% today. In commodity markets, mostly negative. Copper prices down 2.2%. Oil prices down 2.3%. We're looking at $100.25 a barrel. And we've got gold prices down 2.5% today, $1,729 an ounce. The Aussie dollar is just above parity against the US dollar at the moment. At the start of the week it was around 103, 104. It's now 1.001 against the US dollar. Another signal or sign of the risk aversion that's back in markets now, given concerns about what's happening in Europe, what's going on with the banking system in Europe, what that's going to mean for the European economy, the global economy, and for risk assets like the Aussie dollar. Okay, that's it for today. I'll be back tomorrow.